Welcome to today's episode of the Transatlantic Tech Talk, your podcast for policy, politics, venture capital, and technology, from Silicon Valley to DC, from London to Brussels. I'm Veronica, broadcasting from Europe. Today we'll give you the broad overview and the bigger picture in terms of the market's reaction to the big tariff packages imposed on Canada, Mexico, Europe, and China, and how the markets reacted. We'll give you a deep dive into the repercussions of the meeting of President Zelensky and President Trump in the Oval Office, and why the new German government is ushering in a paradigm shift in European defense spending.
This is Stefan, dialing in from New York City. The past 2 weeks have been the most intense and volatile period in policy and in markets that we've had in the past 5 to 10 years. So we're here to break it down for you. In particular, I'm going to highlight some of the recent developments in crypto and digital assets market, including the creation of a national digital assets reserve in the US, as well as the White House Crypto Summit. We'll talk about artificial intelligence and the pace of progress in the latest generation of foundational models. And we will cover recent events in China with regards to both the economy, artificial intelligence, and the policy and regulatory environment. Stay with us. All right, in line with today's episode title, Buckle Up, we're going to start by talking a little bit about the recent meltdown in the markets. This week in stocks, in particular in the United States, we saw a very, very dramatic drop over multiple trading sessions. Most of the major indices are down by 10+%. Many of the major tech and other stocks have dropped dramatically. And what's the reason for that? A lot of it is a reaction to the tariff announcements. So as we all know, President Trump announced new tariffs at the beginning of the week, or in a sense, announced that he would follow through with some of the tariffs that were already threatened previously against Canada, Mexico, etc. But really doubled down on execution. Announced that they would enter into force and scaled up the tariff regime quite aggressively. And that, just sent a shockwave through the markets and the media and the analyst world. Because, a lot of US companies are very, very heavily exposed. They rely on, Mexico, China, and other geographies for their supply chain or as a destination to sell their goods and services. So this could really have a substantive impact on revenues, on earnings across the board. And not only that, but another element I wanted to point out here is it's actually the economy and markets going through a double shock. The one shock is the tariffs, right? Which again are going to impede trade and impose additional costs on businesses and consumers. The other piece is the reduced government spending. As we know, with DOGE and other initiatives, the current administration in the US is both looking to cut federal spending across the board. But even specifically, more recently, they announced they want to take back a lot of the Biden-era subsidies and programs, for example, the CHIPS Act. So if you combine, higher costs for businesses, reduced government spending, and reduced subsidies, you get a mix, a cocktail that you want to say is toxic for the stock markets and for companies. Now, to be fair, we don't really know how this environment is going to evolve, right? It might be that tariffs are only in place for a couple of weeks. But again, we talked about last time, this volatility, this uncertainty in terms of what is the situation going to look like, what is the policy environment going to be, is just hurtful for businesses because you're not able to shift your supply chain within a week or within 4 weeks notice, right? These are adjustments and refinements to the way you operate your business that take months, if not years, to adapt. And so that's why we've seen what we've seen in the markets. And for everybody listening in from Europe, another element to point out is I think in most European countries, people don't talk about the stock market all the time. But here in the US, it's huge because there is, full TV channels and primetime national television dedicated to how the markets are doing. There's really popular shows and programs out there that people consume. And, stock ownership is way higher. Almost, every employee has some level of retirement accounts that's in the stock market. So basically, I want to say, 30, 40+% of people see what's happening in the markets on their balance, on their accounts, with their brokerage, in their app. And so it's much more salient and much more top of mind. Plus, Trump got elected in the expectation of pushing markets higher. And that was, one of his key goals. So that piece is a little surprising. And the other piece, too, is Trump arguably won the election because of inflation as a pressing issue, and because Biden and Harris weren't perceived to be competent enough on the economy. So you would anticipate him to work on reducing inflation, right? But at least in the short run, all this action, including in particular the tariff action, is going to increase inflation. And we'll have to see how even individual consumers and retail folks respond and what that does to Trump's approval rating in the long run.
Thank you, Stefan. It was a great rundown about what's been happening in the US. I guess a double whammy is what you would call it. It's you have both the tariffs that will have their implications. You will see them on the inflation, but also the cut in government spending. We have mentioned Doge and the uncertainty what this will bring also in terms of public spending in the US. I guess it was a big week, big 2 weeks for the transatlantic relationship in terms of the European developments. Of course, the tariffs have been up on the agenda, and I would certainly argue that Europeans are not watching the stock markets. I think it depends on which bubble you're operating in. But this week, of course, we were closely watching also what was happening in terms of the implications due to the tariff packages. I think what was really interesting is to see the different approaches, because it's not only Europe affected or likely to be affected, very likely, but also Canada and Mexico. And in terms of the handling and kind of the political approach to that, I think President Sheinbaum in Mexico, and Trudeau and in Canada, and the European leaders had very different approaches so far. And I do see and find it very interesting, and like who is, I think, handling it the best. Right now, we see a great response to the Mexican response. Not only if you have a look at the messages that President Trump is putting out there on Truth Social, praising the relationship with Mexico now that they have gained a little bit of a time to reconsider, but also in terms of comparing the positioning the domestic economic agenda. You see that both Trudeau and Mexico are very strong in terms of buy local, buy made in Canada or made in Mexico. I think that's also picking up in Europe for sure. Something I was curious to see is that certain member states in the European Union start putting on like little stars and stuff like that for products that were produced and manufactured in the European Union. So I guess we can see, on a more concrete level, how the tariffs and the upcoming trade war are already manifesting in manufacturing and retail, basically. So I think that's on a small scale level. You mentioned the supply chains. I think that's really a key issue here. Our economies are built on globalization, and I think one long-term gamble that the U.S. administration is just kind of doing here is seeing the trade deficit and the surplus that the U.S. has in terms of digital services, and of course that would upend the entire, not the entire, but the previous kind of logic of the trade system we were operating on. And Of course, the European Union is right now preparing the countermeasures depending on what's really happening and coming from DC. And so I think that is certainly a very delicate balance and the question on which parts are on the negotiating table. It's not only the actual goods, so we're of course looking especially at steel and aluminum, the automotive industry, of course, which will be highly affected, the digital services and the tech platforms behind that. But of course, are also on a larger geopolitical level, the implications we will have on the battlefield and the question on the security packages. This has been front and center in Europe following, well, a certain meeting in the Oval Office last week. Europe is reacting. We are uniting. It's really a new sentiment and a new approach here, kind of regrouping and uniting due to the imminent threat in terms of the defense and the war happening in Ukraine. What was important were the reactions to the Oval Office meeting, which were most notably the quick reaction, very swift reaction by the soon-to-be German Chancellor, Friedrich Merz. We mentioned him in our last episode, which was still before the German elections. We had the results come in, and as we predicted, the center conservative parties won, but with close seconds, the AfD, which is the far right, and the socialists, which will now be forming the center parties, a new government most likely. And what is really the key moment there was following the Oval Office meeting, kind of a full circle moment. Back then, when the war started in Ukraine, Chancellor Scholz had back then announced that there would be a Zeitenwende, which is a change of times, change of in terms of defense in Europe and in Germany especially. And now this is the full circle moment because now Friedrich Merz has actually the domestic backing and the European backing to unlock these funds. I think not very surprisingly, Germany is very austere and has had a very austere financial policy in terms of spending, unlike the US, I might say. For the listeners from the US, I think it's important to know that in the European Union, we have certain debt and fiscal rules. So member states should not extend their spending and their deficits more than 3% of the GDP, which is quite difficult to uphold for some countries, and especially Germany has been upholding this policy together with several others. There have been calls to abolish that policy, especially in looking at the impacts that the war has. And now, due to the development at a geopolitical level, Germany has now the backing to push and has now already proposed significant spending in defense and also in infrastructure projects that will hopefully, and the general optimism is here, unlock spending and might reignite the German engine that is so crucial for a lot of other European countries. It was not only Germany reacting, but also the European Commission, Ursula von der Leyen, proposed the ReArm package. As you know, she has not the power to, like the president in the United States, to issue an executive order, but it was also a breakthrough, a moment in terms of really sealing that commitment and saying that the European Union is going to unlock funding for the defense. What is tricky right now, also to give the bigger picture, is on how to actually unlock that funding, because you will need to find a compromise with the European Union member states. And I think also what I will be looking at the market's reaction, whether it's going to be European defense companies benefiting from that, or if it will be US companies benefiting from that, because it's of course a question where those funds go. And the second point that I think will be interesting for our audience is also the question, where is the money actually coming from? So it's significant funding, and it's not easy to find those billions. So one approach is very likely that the remaining funds from the COVID package that was back then agreed between member states will be shifted, and those funds were dedicated to digital transition and the sustainability agenda of the European Union. So we will, of course, closely watch if some of this funding for the digital transition will be moved to the defense sector and how the markets react to that, of course. One more important point to watch here is whether the member states of the European Union actually find a compromise to enter shared debt. That's always been a critical point because, as you might imagine, different countries have different approaches in terms of debt. And if you agree to a shared debt, mutual debt, well, you're all in. So whoever is kind of adding a little bit too much in their debt for maybe a social program or infrastructures that benefit certain sectors of their own country, there's of course high scrutiny from the others. So that's a little bit of the backdrop of the defense packages that were presented this week. And we had last minute summits being called for. So there's a lot of things happening, not only in Brussels, but also especially from the capitals, namely Berlin, Paris, and London, as well as those countries who are bordering Russia, of course, that have a high stake interest in swift action.
Amazing. Veronica, I appreciate the update. It's always good to get your on the ground insider's perspective. Personally, I'm in New York City right now and I haven't been in Europe since January. So I'm always learning in every one of our conversations. I have a few quick reactions. One element going back to our last episode that I want to point out here is, last episode we talked about this realignment, right, of partnerships, of alliances, and we really saw that play out, I want to say, in response to the Zelensky-Trump Oval Office meeting with the summit that happened in London afterwards, where all the European leaders, some of the main European leaders, came to London. Trudeau flew in, and they all met together to discuss, the future of Ukraine and the defense of Ukraine. And I remember the last time, people got together for an emergency meeting in London. The past 5 or 10 years, that would have been unthinkable. So I think that kind of proves our prediction or some of our analysis from 2 weeks ago right in that circumstance. Another element I want to highlight is this paradigm shift in Germany is huge. Like, for our US audience, that is a game changer. Like, the elections went more or less the way we expected, but now Germany is forming a government and a coalition that's going to be more functional because it's only a two-party coalition and not a three-party coalition. And also in the previous administration, there was a liberal, Secretary of Treasury, finance minister, who was very keen on not spending more, not spending too much, which, I understand and I sympathize with, but in the current environment, right, it's going to be very important to unlock additional funding and to make more aggressive and more bold moves. And as Veronica rightly mentioned, the new chancellor, Mr. Merz, also has a stronger mandate. So we really expect the role of Germany to shift and Germany to step up immensely in the next couple of weeks. And you can maybe compare it to Nvidia and the S&P 500. Like, Germany is the European Union's largest economy. It has enough weight on its own to pull the market up or down. So once Germany decides to really, for example, double down on defense, increase their spending significantly, that's going to shift the entire conversation because Germany has such a strong force and gravitational pull, and it would give such an important boost to the local ecosystem. So this paradigm shift in Germany in terms of government spending in general, getting rid of some of their fiscal rules and restraints, and deciding to spend more in the coming years, that is going to make a huge difference. And, I think it's also an outcome to an extent of the Trump-Zelensky meeting. Europe is understanding that it needs to be sovereign and self-sufficient in its defense policy and in its defense capabilities. And we're going to see the trickle down effects of, the White House Oval Office meeting and other conversations that happened in the last couple of weeks. We're going to see that play out in the next couple of months in terms of, we'll take time to get an institutional response and to put the pieces together. You mentioned correctly, figure out the funding sources, agree on, how and when and where and what it should go towards. But there's very strong momentum and very strong will, as my understanding, to make these changes and to really ensure that Europe will be able to defend itself going forward. That is super interesting. One final thought: I like the idea. That was a new, concept to me, but appreciate you sharing, of shifting some of the spending that was earmarked for sustainability towards defense. That makes a lot of sense, I think, on a European level, on a German level. Some of the sustainability planning and Green New Deal made sense pre-Ukraine, but then Ukraine happened. We have this massive energy crisis, and in the midst of this energy and industrial crisis, to try and shift the energy system towards more sustainable energy sources just puts too much stress and too much load on the system and on the companies. So I do think Europe needs to slow down or scale back some of the sustainability packages and bolster and speed up and boost the defense side, given recent developments. So I'm very excited and I'm pretty supportive of this new idea being pursued here.
Yeah, it's absolutely a paradigm shift, not only in terms of the approach in the defense spending, but the meeting in the Oval Office between Zelensky and Trump had also repercussions in Europe. During the last episode, I compared it to a Band-Aid, ripping the Band-Aid off due to the speeches of Vice President Vance. This time, I would say it seems a little bit like more there's the ink on the divorce papers drying now. I think, again, and I think this is really what we are also trying to achieve here at the Transatlantic Tech Talk, giving the bigger picture. We just had the news that President Trump is now also suggesting new sanctions on Russia. So it seems a little bit like a poker game. It's not great that, human lives are at risk and terrible things happening. But to me, it seems a little bit like a political poker game, seeing who is, upping the ante. Trump is trying to see what can all of the sides offer. And that includes the raw materials deal in Ukraine. Of course, has an important aspect for the chips production and the question on how you can actually have the resources to create your digital markets and economy. And also the question on how the former very close allies is now developing. The European reaction to that meeting was, of course, ranging from pure disbelief to, a little bit like you had a neighbor who you always kind of sided with. You might have had some differences in which plants you wanted in your garden, but you always found a compromise. And now suddenly that neighbor starts putting fire on your fence. I think that's maybe a good description. You mentioned, and I fully agree, that this has been a gravitational force and European leaders are uniting. That includes, for example, Keir Starmer. His role is really shifting. He had, I don't know how many, but an incredible amount of meetings and outings at defense companies in the UK. So it seems a little bit like he has found his new role. And the question for the Europeans is, of course, how to handle now the relationship. I think two observations in terms of lingo. I think Europeans are now kind of differentiating between, is it the Trump administration or is it the US Americans? I've seen that quite often now. So there is a difference here. And another thing is also that there's more differentiation between, is it Europe or is it the EU? Because, of course, some member states like Hungary are taking a different approach than the members that are uniting behind a common front. And so Europe now seems to also encompass the UK again, and really showing those allies are trying to build a new bridge and build a new alliance in regards to the war in Ukraine and the tariffs, of course.
Yeah, maybe one quick reaction, and that was helpful. One quick reaction. I had an interesting discussion over brunch this past weekend on this exact issue of, how far is the US, or to your point, the current administration pushing? And when are they maybe pushing too hard and too far? And I was talking to somebody who was pretty sympathetic to the current administration and their policies, which I appreciate. But my point was kind of this can work, and you might be in favor of a more isolationist approach, or spending less on military aid and support abroad. I understand where you're coming from, but on the flip side, if you push away, Ukraine and Europe or the European Union too much and too far, there will be a response and there will be a fallout. And ultimately, in the long run, if you keep this posture and this tone, there is a world in which Europe decides to align itself more with the BRICS, or maybe let's take out Russia, but with China, with other markets. So I would encourage the decision makers to tread carefully. As we were saying, Europe was somewhat prepared for this, had some level of anticipation. There's a pretty strong response. People are coming together, including the UK and Canada. But I think if the current US administration were to continue down this path of escalation for another year or two or three, you would see Europe, drawing its own conclusions and turning elsewhere for economic integration, for potentially military integration and alignment. And I think that type of shift will take time, but that danger exists. So, yeah, the U.S. was the biggest economy, biggest military capability, etc., in the world. So it's understandable that they have shifting priorities, also based on domestic considerations and other elements in play. But again, if you, to your point, push your former allies and allied nations too far away from you, they might go and look for support and friendship elsewhere. So that's one element to keep in mind in the long run.
I really like your analysis, and I wonder what kind of brunch you had, of course. To maybe bring in a little bit more of a perspective, I think my understanding is that Trump's rationale is also to divide Russia and separate it from China, basically. So that's one of the ulterior motives here. And it's always easier to divide someone and separate them if you bring them a little bit closer. I think that might be one of the reasons. This kind of back and forth approach, keeping both Europe and Russia on their toes. And I think that is something certainly to watch in terms of economic strength. The US, China are the key players, but don't underestimate the economic power of Europe, of course. And that is something we'll be seeing due to the tariffs. Of course, the close connection between the US and Europe. And also in terms of shared history, I think there has been 70 years of alliance based on the 20th century and the different political developments. But also there have been certain assurances from the US, also in terms of defense and security protection. Also those which were to Ukraine, for example, kind of telling them that they should refrain from having and building their own nuclear defense, because there would be the defense protection granted from the US. So I think there's certainly those shifts happening, and it's a moment of pivot for several alliances. And the question will be, is this just a Trump movement, or is it here to stay? So I think that's basically also what the leaders, not only in Europe, but also in Beijing, and, for example, same in India, need to decide, because, of course, for the EU, for example, India is a very, interesting possibility in terms of a new partner for alliances and trade. Should we move to the next topic?
Absolutely, yes. On the topic of buckling up and volatility in markets, we're also going to dive briefly into digital assets and crypto. It's been very eventful. I'm sure many of you followed. There was the so-called crypto winter in 22, 23, 24. of crypto markets facing a very strong downward trend based on various, scandals, issues in the industry, but also just very heavy-handed enforcement, especially here in the US by the relevant federal agencies. And that all gave way to massive bullish sentiment, once Trump got elected in November, and markets shot up in November, December, January. Bitcoin crossed $100,000 for the first time. But now markets are back down. I think the markets gave up all of their gains since November. They're actually in the red for the first time. And we just wanted to discuss that briefly because it has to do, of course, with the political environment, with what we've seen happening in the industry, and it's in a market in today's financial ecosystem. So to break it down in a little more detail, I think one issue that we've seen is there was a lot of excitement. There was a thesis around once Trump gets elected and crypto gets deregulated, we will see more value and we will see more building in the US. We will see more entrepreneurs go in and build meaningful products. But it seems that at least initially, it almost had the opposite effect. So many of you might have seen President Trump or people affiliated with him launched a meme coin on Inauguration Day. We mentioned it briefly in our episode, the Trump coin.
Don't forget Melania coin.
There was a Melania coin. As with most of these meme coins, they went up initially. A lot of insiders made, substantive money. Most retail traders and retail investors who joined later have lost money since. It's a tale as old as crypto, one might even say. And that's kind of disappointing, right? Frankly, if you think about it in terms of consumer protection, and it kind of sets the precedent. If the president and his affiliates can go and create a meme coin and profit of that, anybody can go and do it. And I think it's an incentive problem. If it is very, very easy to make money off the back of retail traders by playing very simple playbooks and strategies that have been iterated on many, many times. No incentive to go and build something new or more daring or more complex or more valuable. So I think a lot of the energy in the space is back to creating some of these short-term projects and protocols where you can generate a profit, but it doesn't really fundamentally do anything or build anything, create any value. So that's one big challenge. Another example was the Milei-backed project in Argentina, the so-called Libra coin. There, was another project that basically was going to be affiliated with the president of Argentina in this case. He backed it. He publicly tweeted his support. The token went up by a large, significant percentage. People cashed out. Token collapsed. Milei got into trouble for that domestically, but there was some reporting afterwards and some investigative journalism that uncovered a lot of the layers behind both the Libra coin, Trump coin, Melania coin, and that I think shook some people and some market participants' trust in Solana and the sustainability of the meme coin ecosystem and how that story will unfold. At the same time, as we know, crypto is a risk-on asset. So whenever there is very high volatility or there's policy uncertainty, such as with the tariff situation, as a high-risk asset, it's going to go down and it's going to retreat. So I think there's multiple reasons for why crypto has gone down so much in recent weeks. But it'll be interesting to see how the space evolves, both in terms of the products being built and the general market trends. We have seen just yesterday the creation of a national crypto reserve in the United States by executive order of President Trump. It doesn't mean that that the Treasury or the Federal Reserve is going to start buying Bitcoins, some type of long-term reserve. For now, it just means that any Bitcoin, Cardano, and other assets that the U.S. recovers in some of its proceedings, for example, against illicit actors, that those proceedings are not going to be sold at market right away, but that they're going to be kept and held and stockpiled to potentially be sold down the line. So far that makes sense, but I think it's it's just it's not a larger policy shift. It did give the market a plus 10% bump recently when it was announced, but it's not really a sustainable driving force of the market. One thing that's happening today, which is definitely very different from the Biden era, there is a high-level crypto summit happening at the White House with many major industry representatives and executives and CEOs. Biden never met any crypto industry leaders. They never got invited to the White House. I was working in part in this space at the time, so I was following this quite closely. So it's definitely a change of tone and a very different posture of the administration, as we talked about. But surprisingly, or maybe not, that actually has hurt the market and hasn't really benefited the market. So I think it'll be very interesting to watch how the crypto space evolves going forward. And the crypto task force, is meeting in DC. There is going to be legislative packages. There is going to be more initiatives. What we've already seen is the enforcement agencies, such as the SEC, Securities and Exchange Commission, dropping a few cases. They notably dropped their case against Coinbase that had been, going on and pending for 2.5 years. So that is a big tailwind. But even then, the same day, the stock actually dropped 10% because of other developments. But so, the excitement that was there, I think, in early November on election day has certainly given way to some fatigue, and we're in more muddy, troubled waters right now in terms of the digital asset space. And we will need to see if there can be a course correction to go back up, or if the current, turmoil to negative bearish trend will persist going forward.
Absolutely. Thanks for the great summary, Stefan. As you said, not only muddy water, but murky water. It's a little bit the friction between formalization, which you can see through regulations and, an increasing visibility of the sector and the DeFi sector, versus the high volatility, which certainly also attracts some traders, and also the pacing of that process. We've seen other disruptive products over the last decades, of course, and I think here it is especially interesting because you have this very close connection between capital markets, now the involvement of the government and regulators, and also the disruptive nature of the product. And I think we can also compare it to other market sectors. Of course, if you're looking more at AI or quantum with Majorana lately, the implications that those will have on other sectors. I'm thinking of the possible shift in tariffs and supply chains that might have. So I think it's will be very interesting to see the development of DeFi, and if repercussions of the shifts that are happening right now, how they will develop after he will have stepped down, and how the market will develop. And same for, you mentioned Coinbase, and same for the SEC lawsuit that was dropped against Kraken. And on the other side of the Atlantic in Europe, you're seeing the authorizations coming in regard to the MiCA regulation. There's a lot of things happening, and this formalization is really at high speed and as we speak.
Awesome. Okay, we've got one more exciting segment on the latest events and trends in artificial intelligence. We talked about DeepSeek last time, which was, all over media. We just wanted to give a quick update there. One observation that we had is we have a new generation of foundational models that was released in the past 2 weeks, both OpenAI with ChatGPT 4.5, codenamed Orion, and Claude with an update to their Sonnet model from 3.5 to version 3.7. And, I've tested them extensively. There's also other reviews that you can find online. And what is interesting is almost the lack of progress. So a lot of people note that there's no substantial improvement. There's a lot of a strong thesis around we're still at this exponential side of the curve, right? Of models getting exponentially smarter every 6, 9, 12 months. And it seems like that curve is really flattening. And we're at this inflection point where models will still get marginally better, but it will take way longer. And the improvement is not going to be as drastic as what we've seen in the past. At least that's my takeaway. So based on this, I would wager a bet. I discussed this with Veronica before, that I personally don't think we will see AGI in the next 6 months or 9 months or 12 months. I think there's a lot of buzz, a lot of noise, a lot of industry executives and tech executives trying to talk their own book, trying to raise more money for their venture, trying to support the stock price. So of course, there's going to be some bulls out there who say this is working perfectly and we'll be in AGI in seconds or 2 years. But I think from what we're seeing in the public releases and the things you and I have access to, I do think we see the pace of progress tapering off, which maybe is a good thing because maybe we need some time to digest. Maybe we need some time to think about good, responsible frameworks. But let's just say our take is whatever you see in the news, take it with a grain of salt. Yes, these companies have insane levels of funding. Yes, people are still buying NVIDIA GPUs like crazy. DeepSeek hasn't really changed the equation too much in terms of what the hyperscalers are doing and how, large US big tech companies are thinking about the space. But having said that, it's important to be cautious and not always believe the most optimistic narrative that is out there. And look, trade has actually come back. This is in part related to the general market drawback with the tariffs, but the trade is not as strong as it was a couple of months ago. Initially, the markets recovered from DeepSeek, but now obviously NVIDIA and other companies are very highly implicated by tariffs in terms of their supply chain, in terms of their exports to China. So NVIDIA is down substantially over the past week or two. Same with the hyperscalers. So I think we're starting to see some cracks in the AI trade and in the AI narrative. And we will see if those cracks are going to heal, if there's going to be moments like new releases, like next quarter's NVIDIA earnings that result in people being very bullish and very confident again. But I think for now, both from an investing perspective and from a general, theory of the world perspective, I think it's good and healthy to take some of the announcements with a healthy dose of skepticism.
Stefan, you mentioned it. We discussed this before our recording. I will, for future reference, so you predicted AGI is not going to happen in the next 6 months. So if it does happen, I guess we will, I don't know, maybe you can give me a Melania coin or something. I'm open to suggestions.
We'll have something, yeah. I'll even up it, I'll double it to 12 months. Confident, like 98% confidence. There's not going to be anything AGI-like within the next 12 months, probably even 24. So
the good thing is, I think since the 1970s, people have been saying like AGI is going to happen in the next 6 months. Well, it hasn't happened now. And I also one aspect to keep in mind, it seems that the definition of what AGI actually is also shifting. So I believe if we were back in the 1970s, if we had something like Le Chat or ChatGPT, I'm pretty sure we would have said, well, this is close enough. That's AGI. And nowadays we're like, yeah, it's not perfect. So we're going to look for something else. So of course, the definition of that simple LLM is not AGI just yet, but just a question of what we actually define as AGI as the term is also shifting, and that's going to be crucial. And I think that's where we have a little bit of leeway for negotiation and interpretation.
Sure. Let me just give you 2 examples here. So one example, this is in my kind of daily work, over the past week. I do some work on like frontier models and kind of in the AI space. And so one example is very recent, and I think it's startling. It's one of the current latest generation models. You ask it a question. You ask it to give you a list of 20 items, let's say, and in the response, it's going to give you, but in the introduction and the conclusion, it's going to say, oh, look at this amazing list of 20 elements that I pulled for you, but there's only 6 elements, and it's a very basic, from a human perspective, very basic error, very basic mistake. But it would keep making that same mistake. So I think there's a few moments or types of where you realize these systems are not as insanely smart and human-like intelligent as they're often made up to be. There's another example where, I'm building a little script now in Python, I'm coding, I'm building a little, product. And even there on the code side, it's easy for the model to forget a feature that we introduced before, or give me code that's not working. So I have to prompt it 3 or 4 times to find the right combination of commands and definitions. And coding, is one of the most standardized, logical, automatable tasks you can think of. And even in coding, right, there are times when the models really struggle. So I want to say, yes, for a casual query of, what's the weather like in this or that city, or, give me some ideas, or give me a draft essay. There's a certain type and class of actions and analyses where we get a very strong feedback. Yes, this is basically thinking, and it's, it's almost conscious, and it's in me, and this is so exciting. But then once you change gears and confront it with a very different type of task, there will be a lot of moments where, you're really going to be like, whew, sheesh, what is it actually thinking? Is it even like, can I please talk to a human? Like, what's going on here? And I think we need to be mindful of these both sides and keep that perspective in mind as well.
One example I really liked last year at MIT was saying that, as long as an AI cannot be seated at the front of your door and then navigate to the kitchen if you ask it to make a cup of tea, an AGI should be able to do that. Of course, if it's in a robot, all of those parameters are working. So I think that's a very good example to see how many actually factors need to come together in terms of orientation, remembering the rooms where the kitchen actually is, how hot the water would need to be to actually mimic something as a human intelligence. For us, it's really simple, but if you add up all of the processes, that it's massive, as you just said. And I think for everyone, including me, I feel very sophisticated since I heard that analogy when I make myself a cup of tea or coffee. Something to look forward to.
I love that. Yeah.
Drawing up on your comparison with DeepSeek and the Chinese tigers, I think one area to watch this week and for the next coming weeks are the 2 big sessions happening in China. They have started this week. It's basically 2 sessions, both from the Communist Party and the Advisory Council, the CPPC, that are drawing up the economic and broader policies for China. You have, of course, the Communist Party giving the line to take. They have already announced that there should be a 5% GDP for 2025, which is, of course, in line with their political approach to the macroeconomic policy, kind of giving a 5-year plan and then building from there. What will be interesting for us to watch is, of course, their reactions to the tariffs. And they have already, of course, announced the retaliatory measures, but that will be certainly insightful to see what the Chinese have drawn up as a response to the US. And in terms of tech regulation, there's also most likely something to be expected in terms of AI regulation, and also the question on how they will be handling the question of Taiwan. We mentioned Ukraine before. You've mentioned the successes, for example, from the AI tigers, including DeepSeek and StepFun, but also big tech with Alibaba, Tencent, Huawei, and ByteDance. Of course, those had significant successes. So those policies will have a huge impact on them as well, and their future and how those stocks and overall their companies will perform over the next year and beyond. So I guess that will also be a great topic for our next episode of the Transatlantic Tech Talk.
Amazing. Now, I wanted to add briefly there. There was a great piece in the Financial Times earlier this week around talking about stocks, right? How Trump so far with tariffs and other proposals has basically ended the period of US exceptionalism. We talked about US exceptionalism in our last episode. It's basically this notion that US markets and US equities were being traded and being valued, at a premium towards everyone else, including Europe, including developing markets such as China. And now that trend seems to reverse because the US markets drop, 10, 15%. And China is up. So people are talking about China again. People are considering investing in China. Chinese stocks are still way down from where they were before some of the domestic upheaval, economic upheaval, COVID-19, and more restrictive policies introduced by Xi Jinping. But there's definitely been a bounce back thanks to news on the AI side. Of course, now the same way that Microsoft, Amazon, Google, etc., want to jump on the AI bandwagon and increase their stock price and their market cap by talking a lot about AI. Chinese companies are doing the same thing and announcing new initiatives, new investments, and that in turn drives up the stock price. So we've seen that lately with Tencent, with Alibaba, and see if Chinese markets can, mount a real comeback. It's still probably a tricky time, and it's going to be choppy to invest into Chinese stocks, but they're definitely up from the very low lows that they'd been in for a really long time, basically 2, 3, 4 years. So if you have a more global portfolio or a more global perspective in your investing, it's definitely an interesting corner of the market to keep an eye on in a couple of months.
Depending on how the tariffs will strike, I think that's really because those certainly hurt the Chinese. But same for the tariffs on Mexico, Canada, and Europe. Who knows if they're here to stay, or if President Trump still tweaks and turns a little bit on those that he has announced.
But to your point, there's more pain to come in the markets, and if we continue on the current trajectory, it's going to be universal. It's going to be shared between the Americans, the US equities, the Europeans, European equities, Chinese people, consumers, and equities. I think it's going to be a general, broader burden that will be shared by, markets around the world if we continue down this path.
Certainly interesting times. Well, I guess that's it for now, and we have the perfect cliffhanger for the next episode of the Transatlantic Tech Talk. Stefan, it's been great. I really enjoyed discussing with you the repercussions of the very eventful last 2 weeks. Thank you for listening and joining us for the Transatlantic Tech Talk. Feel free to leave a comment, give us feedback, and of course, if you like the Transatlantic Tech Talk, follow us, and we're waiting for your 5-star reviews. This is Veronica from Europe.
Thank you, Veronica. This has been great fun and great learnings. As always, Stefan signing off from New York City. See you at the next one.
See you.